This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 29, 2026, and this is the After Hours session. Now, let's get into it. We are looking at a market in deep freeze. The Fear and Greed Index has plunged to 14 out of 100, painting a picture of extreme investor anxiety. Yet, the VIX, the measure of expected volatility, is sitting quietly at 18.67. It is a study in contradictions. The street is terrified, but the options market isn't pricing in a crash. Tonight, we dissect why the US dollar is acting as the sole refuge, while risk currencies like the Australian dollar and the Japanese yen face a perfect storm of liquidity drains and central bank divergence. Before we dive into the tape, let's look at the calendar. The big event has passed. The Federal Reserve kept rates unchanged at 3.75%. But the silence wasn't empty. Chair Warsh was clear, telling us the economy shows impressive resilience and they remain resolute to deliver price stability. That is the headline that is moving the boards tonight. Looking ahead, tomorrow brings the Bank of Japan rate decision on July 30th at 3 o'clock UTC. That is the binary event. Following that, we have USDJPY, initial jobless claims, and the crucial PCE price index on the 30th. These are the numbers that will validate or invalidate the Fed's resolute stance.
And that validation is what I want to flag immediately. Pulse painted a picture of a Fed that won't budge, but Grid pointed to the technical cracks in RC and gold. The market is trying to reconcile a resolute dollar with a fear index that suggests everyone is bracing for impact. The question isn't just about the Fed anymore. It's about whether the BOJ can stop the dollar from running roughshod over carry trades before Thursday's data dump.
Let's start with the noise. The headlines are flashing red on the equity side. Microsoft shares extended gains 7% after hours following strong CAPEX guidance, while Meta sank 11% as the CFO warned of continued heavy compute spending through 2028. Stocks closed near lows overall, with markets digesting the Fed's hawkish hold. How does this equity divergence feed into the FX desk?
It feeds the fear. That 11% drop in Meta isn't just tech noise. It's a signal that capital expenditure is eating margins faster than revenue can keep pace. When large-cap growth stumbles, risk appetite evaporates. We see that in the 14 out of 100 fear and greed reading. Investors aren't pulling back because of a technical glitch. They're pulling back because they feel unsafe in the current yield environment. The impressive resilience Warsh cited. The market disagrees. They are pricing in stagnation, which means they are fleeing to anything that isn't a liability.
Exactly, and look at the positioning on the liability side. In Australian dollars, leveraged funds are still holding a net plus 24,788 contracts. That is a massive, crowded long book on a currency that is currently trading at its 5-day low of 0.69455. When equity risk hits like Meta did, those leveraged longs don't just fold, they get squeezed. Meanwhile, in the British pound, asset managers are net short negative 8,897 contracts. The institutions are already shorting the fade. The equity weakness provides the cover for them to unload.
But here is the trap, CIPHER. You're looking at the crowded longs in Aussie as a target for unwinding, but you're ignoring the silence in gold. Gold is down 0.06%, testing its 5-day low of 4,022.68. If the market were truly afraid of a systemic equity collapse, gold should be rallying. Instead, it's being sold. Why? Because in this resolute Fed environment, cash is king. The low VIX at 18.67 tells me the market is underpricing the risk of a liquidity crunch. Gold isn't just weak, it's being sacrificed for dollar liquidity. That is a much scarier signal than a Meta dip.
So, gold is losing its luster even with fear at 14 out of 100. Let's pivot to the heart of the FX mess, the US dollar and its interaction with the yen. Dollar-yen is trading at 163.592, down only a fraction of a percent, but hovering near its 5-day high of 163.951. It feels stuck. What is happening in the flow here?
It feels stuck because the plumbing is clogged. Look at the yen side. Leveraged funds are net long Japanese yen by plus 1,209 contracts, but look at the week-over-week change, plus 97,394, 97,000 new longs added in a single week. That is an explosion of speculative yen buying. At the same time, asset managers, who actually move the needle, are net short negative 3,290. The retail leverage is screaming yen, but the smart money is fading it. The reason dollar-yen hasn't exploded yet is because those 97,000 longs are waiting for the BOJ decision. They are holding their breath.
And holding their breath is dangerous technically. Dollar-yen is compressing in a tight range of 163.329 to 163.951. Right now at 163.592, it is right in the middle. Grid level support is at 163.329. If we lose that, we open up the lower liquidity zones. But more importantly, look at the correlation. Aussie dollar is at 0.69455, testing its 5-day low of 0.69376. Aussie yen is essentially the sum of these two disasters. Aussie is hitting bottom and yen is over-leveraged. The technical structure for Aussie yen is a coiled spring. A break below 0.69376 in Aussie dollar validates the bearish trend, which mechanically forces Aussie yen lower, triggering margin calls on those 97,000 yen longs.
Which brings us back to the BOJ binary. The Fed said resolute, meaning higher rates for longer. The BOJ meets tomorrow. The market is priced for a pause. If the BOJ says nothing, those 97,000 yen longs survive. If the BOJ signals even a hint of hawkishness, or worse, intervenes, that leverage becomes toxic. Pulse sees this as a policy divergence nightmare. The yield differential is wide, with the 10-year at 4.61% and the 2-year at 4.26%. That spread is feeding the dollar bid. But the crowding is so extreme that a small move triggers a large reaction. It's not about direction anymore, it's about velocity.
Velocity is what kills accounts, Pulse. And notice how no one is talking about the Swiss franc. Swiss franc leveraged funds are net short negative 8,897. Safe havens are being dumped across the board. When gold, Aussie, and Swiss franc all show signs of liquidity drain simultaneously, you aren't looking at individual currency issues. You're looking at a dollar liquidity sponge absorbing everything. The VIX is at 18.67, which is low, but it's a false calm. The danger isn't that the dollar drops. The danger is that the dollar rises so hard it causes a margin cascade in the carry trades. That's how you get a VIX spike from nowhere.
Let's look closer at that Aussie dollar breakdown. 0.69455. 5-day low is 0.69376. Is this a bounce opportunity or a breakdown?
It is a breakdown waiting to happen. Technically, Aussie dollar has failed to hold higher frames. We saw support at roughly 0.6970 and now we are testing the 5-day low. On the daily chart, this is a breakdown of the recent consolidation range. The resolute Fed narrative has broken the psychological support levels that held through last month. I am watching 0.69376. If we close below that, the next technical marker is the lower liquidity band around 0.6900. There is no bid support between here and there. The path of least resistance is down until proven otherwise.
There is no bid support because the buyers are gone. Remember, asset managers are net short negative 35,144 in Aussie. They have been exiting. The leveraged funds are still long plus 24,788. But that is speculative heat, not institutional conviction. When the price starts ticking towards 0.69376, those leveraged traders will hit the stop losses. That sells the price further, which triggers more stops. It's a feedback loop. CPTF data confirms it. The long side is crowded, the shorts are institutional, and the price is sliding. This is a textbook squeeze setup.
And the sentiment data backs the squeeze. Retail sentiment is overwhelmingly bullish on Aussie because they think it's cheap, but the fear and greed index is at 14. When fear is this high, correlations go to 1. Everything gets sold except cash. The cheap argument doesn't matter when the entire global risk complex is repricing downward. The Fed's comment about impressive resilience removes the excuse for Aussie to rally. If the US economy is resilient, the dollar wins. Simple math.
What about the euro? Euro-dollar is trading at 1.1398, up 0.1%. It seems like the only green light in a red room. Is euro-dollar safe?
Safe is a strong word. Euro-dollar is holding inside its 5-day range of 1.13533 to 1.14183. It's currently at 1.1398. Technically, it's respecting the midpoint of its range, but look at euro-sterling. It's at 0.857215. The euro isn't strengthening, it's just falling slower than the pound. Cable is at 1.3296, near its 5-day low of 1.32734. So the euro is just the least bad option among G10 currencies right now. It's not a buy signal, it's a hold signal for now.
Agreed, the flow data for euro shows mixed signals. Leveraged funds are slightly net long, but not aggressively. There's no crowding here like there is in Aussie or yen. That lack of congestion is what's keeping the price stable. But watch the euro-Swiss. Swiss franc leveraged funds are net short negative 8,897. If the ECB signals dovishness while the Fed stays resolute, euro-Swiss could crack. But for now, the lack of institutional flow in euro-dollar means it's drifting, not trending.
Drifting is risky when the wind is blowing the other way. The resolute Fed stance creates a gravitational pull toward the dollar. Euro-dollar might be flat, but that's a calm before the storm. Once the BOJ decision hits tomorrow, if the yen strengthens, it pulls euro-yen down, and that drags euro-dollar along via cross ratios. Don't mistake stability for safety.
Let's talk about the odd one out, gold. Gold is at 4,022.68. It's down 0.06%. In a fearful market, gold should be soaring. Why is it being sold?
Because it's not being bought as insurance, it's being sold for margin calls. Here is the contrarian risk flag. The VIX is at 18.67. That is low volatility. Low volatility breeds complacency. Complacency breeds leverage. When the BOJ announces tomorrow, if they surprise, the VIX will expand rapidly away from that 18.67 floor. If that happens, anyone who bought gold thinking it was a safe haven will find themselves underwater. The fact that gold is testing its 5-day low of 4,022.68 while the fear index is at 14 is a divergence. Usually, fear buys gold. Fear is not buying gold here. Cash is buying gold. Wait, no. Cash is being hoarded. Dollar is being hoarded. Gold is being liquidated. That is a systemic signal that liquidity is drying up in non-cash assets.
Technically, the chart is ugly. Gold is making lower lows. It broke below the psychological 4,150 mark. Now it's hovering at 4,022. The 5-day low is 4,021.41. If we lose that, we are in uncharted territory below 4,000. There's no historical support visible on the recent timeframe to catch a falling knife. The safe haven bid has evaporated because the dollar bid is stronger. Until gold can reclaim a level above 4,050, the technical outlook is bearish.
Check the positioning. Leveraged funds are net short negative 500 in gold. Asset managers are net zero. Who is shorting? Not the institutions, not the big banks, just a small amount of speculative shorting. But remember, the big players are long dollar. To buy gold, you often have to sell dollar or hold dollar. With DXY leveraged funds adding plus 4,438 net longs, the institutional preference is strictly for the dollar. Gold is collateral damage. Unless someone steps in with massive buy orders, which the flow data doesn't show, there is no floor.
So we have Aussie dollar crashing, gold collapsing, and dollar-yen coiling at highs. The common thread is the US dollar, but let's look at the crosses. GBPOD is at 1.9144. GBPNZD is at 2.2987. These are high beta pairs. What is the risk here?
GBPOD is essentially a play on the divergence between the UK and Australia. Pound is holding up better than Aussie. Aussie is at its 5-day low. GBPOD is nearing resistance at 1.9200. If Aussie continues to slip towards 0.6900, GBPOD could push through 1.92. Technically, the trend is up for GBPOD. The setup is valid. Short the weak link, Aussie. Long the relatively strong link, pound.
But be careful of the pound side. Remember, asset managers are net short negative 8,897 in pound. The pound isn't strong because of fundamentals. It's strong because the Aussie is weaker. If the BOJ moves and RC stabilizes slightly, GB-PORD could reverse quickly. The positioning in pound is already short-heavy among smart money. You are riding a wave that the institutions are trying to get off of. It's a trade, but a dangerous one.
The danger is the Kiwi side. Kiwi dollar is at 0.578415. It's tracking Aussie but often with higher beta. If Aussie breaks 0.69376, Kiwi will likely break its own supports faster. New Zealand's export-dependent economy is sensitive to Chinese growth, which is tied to the broader risk-off mood triggered by the Meta slump. Don't touch the crosses until the VIX tells us the panic is over. High beta equals fast losses in a risk-off regime.
Let's synthesize this. Pulse highlighted the resolute Fed and the resulting fear. Grid mapped the technical breakdown in RC and gold. CIPHER exposed the overcrowded longs in yen and RC that are primed for a squeeze. SPECTER warned that the low VIX is a trap and that gold's weakness is a liquidity signal. All roads lead to the same conclusion. The US dollar is the winner, but the mechanism of victory is painful for carries. The risk is not that the dollar falls. The risk is that it rises so violently that it breaks the leverage structures holding up RC and yen. Reduce leverage. Watch the BOJ and respect the dollar bid.
To summarize the ShadowQuant Forex edition tonight. First, the US dollar is structurally favored by the Fed's resolute stance and high yields, creating a liquidity vacuum that is draining risk currencies. Second, Aussie dollar is testing critical technical support at 0.69376, with crowded leveraged longs facing a potential squeeze. Third, gold's failure to rally amid extreme fear signals a liquidity crunch, not a safe haven bid. Tomorrow, watch the Bank of Japan. Their decision could either validate this dollar dominance or trigger a chaotic unwind of the very longs we see stacked on the books. Stay lean, stay liquid, and monitor the spreads. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.